Been away from the screens for the last hour. So,
Are you shocked?
breaking news.
Admittedly, this is breaking news to me that stocks have fully bounced back. But I think let's take a step back for a second. We are 40 days into a new administration in Washington, and as many have discussed, I think this new administration has clearly brought uncertainty across a variety of different issues, and whether we're talking about several different wars that are happening, certainly most notably what's going on in Russia and Ukraine, or the tariff situation where we've seemed to be creating a bunch of economic warfare with partners in Canada and Mexico, and certainly China. Combine that with some of the further uncertainty around the economy and interest rates, and it's setting up for an environment where certainly the base level of volatility is higher. And with the base level of volatility higher, ultimately we're going to see more frequent periods where we get large sell-offs, whether those be sell-offs overnight or sell-offs in the early morning, and where intraday volatility increases. This is now the second consecutive day where, if you would look at the high point of futures relative to the low point of futures, you're seeing some very, very meaningful moves. And so I expect that to continue. Is
it just moves, or is it something more fundamentally? Like, are we getting
uncertainty?
Yeah.
I think it's uncertainty. And when uncertainty exists, ultimately, consumers are telling you we're not spending as much. We saw that in the retail sales data. We saw that in the University of Michigan confidence data. And also corporates are telling you the uncertainty exists. Some of the big tech companies are starting to talk back how much they may do in CapEx spend. And when you start to see those things, the market starts to jitter a bit. And when the market starts to jitter a bit, and you start with an elevated level of gross exposure and an elevated level of net exposure, I think you're going to start to see more and more of these days where we trade in 2 or 2.5% equity ranges as compared to what we saw for the majority of 2024.
You said the market's starting to have some jitters. Are you starting to have some jitters?
So as a firm, these kind of markets actually start to set up really well for us. And that's because we deploy a multi-strategy approach where we have certain strategies across our business that benefit from the range expansion of stocks, that benefit from an elevated level of volatility, that ultimately can take advantage of some of the dislocations that we're starting to see form. And whether that be our macro fixed income business, which tends to trade from a positively convex long vol standpoint, or our quantitative trading business that tends to do better when we start to see an increased range in stocks, or even parts of our short-term trading businesses that we've been running for 35 years, where both our discretionary and systematic iterations of those strategies tend to benefit when we start to see the increases in volatility. And so what we're trying to do is we're trying to lean more into the strategies that ultimately benefit from higher baseline level of volatility, and where we need to square our portfolio in some of the areas that benefited a lot from the environment that we lived in, between, let's call it January of 2024 through inauguration day of 2025. We're working to reposition those portfolios. And I think we're going to have to continue to work to reposition those portfolios, because I don't think what we're starting to see happen over the last 40 days is an accident. It's not a surprise. And it's probably something that's going to persist for some period of time.
So the opportunity for you, Ryan, is just in the actual movement and the volatility, or is it, a certain asset class that is, going to actually do well, opportunistic in this volatility? What is it?
Well, our strategy is focused on identifying relative value opportunities. And so for us, what we're going to look for across asset classes is ultimately where the risk premium is most dislocated. And then where that risk premium is most dislocated, we are going to lean into in terms of our risk deployment. And so, the benefit of trading across lots of different asset classes and having lots of different strategies is in certain time periods. That could be in fixed income, that could be in interest rates, that could be in currencies. At other times, that could be in credit. At other times, that could be in equities. And so we're starting to see some of those cracks form in the equities market. And so, that's where I would say our focus has been, in the very near term, but that can shift really quickly. And if FX volatility picks up or we start to see credit spreads widen, we will move risk to ultimately where that risk premium becomes most dislocated.
Is it hard to make bets, though, in terms of an administration that some that we've had on today say, well, you know what, we got to wait on these tariffs because who knows in 24 hours or in a week or in a month?
I think that's the uncertainty that's leading to the jitters that we talked about, because, I think, one day you'll hear one thing, the next day you might hear the opposite. Are these negotiation tactics, or is he being real? I think these are the things that all investors are considering. And I think the market's telling you, I don't like that uncertainty.
Well, I think we learned today that he's being real, given what we saw implemented with Canada and Mexico. So that jury's not out there. Is there an environment that's better or worse for your firm? Like, given that you're multi-strat and you can kind of thrive in any environment, like, what's a bad environment for you?
Massive correlation is a bad environment for us. We benefit from dispersion. And so when a larger part of the moves in individual asset classes can be explained by the idiosyncratic components of what makes a stock rather than what makes the market, those are the environments we benefit from. And so ultimately, when all stocks are moving because interest rates are moving higher or the dollar is moving lower, those are the more challenging and more difficult environments. Now, through the years, we've tried to layer on certain strategies that actually benefit from those environments to try to make our portfolio more all-weather proof and more battle-tested. And so through time, I think we've gotten better at being able to navigate those environments. But certainly when I take a step back and look at our portfolio, we want environments where dispersion is high.
Data is so important in trying figuring out kind of what the environment is, where it goes. And I'm curious about the kind of data metrics or data sets that you guys find are really interesting right now.
Well, I think the benefit of our organization is we've been around for 36 years. And so the most valuable...
a few cycles.
Yeah, we've seen a few cycles. And the most valuable data sets are ultimately the internal data sets that we've created through 36 years of trading in the markets. And they're valuable for two reasons. One, they're full of information. Two, they're the one type of data set that ultimately cannot be replicated or sold to any of our peers or competitors who are trying, to make or to compete for alpha in similar spaces as us. And so we try to leverage that, but we ultimately need to acquire other data sets and build other data sets that ultimately are going to be components to our strategies. And so we invest a lot of money, time, effort, and resource in our data platform in terms of both our data ingestion efforts, our data cleaning efforts, and then ultimately, what do we do with that data? How do we better put the data in the hands of our portfolio managers that can actually then make better behavioral decisions because they're being informed with reliable data?
Is AI part of that equation? I interviewed Ben Wren of SigTech earlier today, the startup that was spun out of Brevin Howard a few years ago, and he creates a product that's meant to really help quants do their jobs very quickly.
So I'll say two things on sort of where we're leveraging AI. Number one, we've been running quantitative trading strategies for multiple decades. We've been implementing different techniques as it relates to machine learning for many, many years right now. The models are consistently getting better. And so we are leveraging AI to ultimately make our models better, which is ultimately going to make our quant trading strategies better. Now, everybody is doing that, or a lot of people are doing that. And so we got to do that better than other people. And so that's where ultimately having the right talent, I think, is the name of the game. And so, yes, AI is changing the way that we do things, but it will not be a replacement for having really talented quants and really talented people. The second thing that I would say is, we are leveraging AI ultimately to make sure that we are maximizing the amount of time that the valuable people that we have are focused on the last mile or the most IP-sensitive components toward our trading strategies and toward our investment strategies. And so if we can take all the parts of the investment process that can be commoditized and we can do those things more quickly and more easily for our talent, then ultimately we could put ourselves in a position where we're spending the maximum amount of time in the most IP-sensitive areas.
All right, so what new asset classes or new markets look interesting?
Yeah, so I would say the three core focuses for us are expanding our volatility strategies, which we've been trying to do over the last couple of years, where we've been able to acquire some good talent recently. I would say number two is expanding and developing our Delta One business. This is a business that's existed for many, many years inside sell-side institutions. Some of that talent has started to migrate toward the buy side. We think we are a first mover in acquiring some of that talent and building out businesses as it relates to those strategies. The benefit there is it's a great opportunity to see where risk premia is most dislocated across a variety of different asset classes. And we've built a great team globally to be able to do that across, probably 20 or 30 different markets at this point. And so that's a second area of expansion for us. And then lastly, it's quant trading. And why quant trading is so important to us is ultimately the barriers to entry are the highest. because of the cost of running quant trading businesses, because of the amount of capex that needs to continuously be poured into quant trading businesses, it is not an easy thing to replicate. And so for us, we have a first mover advantage. We've been investing in it over multiple decades, and so we want to continue to lean into our strengths.
I want to get back to the macro and more about what we've heard from Washington. We do expect the president tonight in his address to Congress to probably talk about the economy a lot. I'm guessing. We don't know what he's going to say at this point. We know he likes
That's part of the
that,
uncertainty.
That is part of the uncertainty.
Creates the volatility too.
But if you think about what many would describe as pro-growth policies coming from this president, or at least his agenda, would you say that those, if they are enacted, outweigh the uncertainty of tariffs?
It's a good question, and I think that's what the market's trying to debate. And the reason we're probably not down more as it relates to the broader market indices is because I think people are having that debate, in their investment committees and in their boardrooms. And I think there's a lot of value behind some of the deregulation policies that are ultimately coming out of Washington. We have a president where he wakes up in the morning and the first thing he does is he looks at equity futures. And I think a big part of his mood is ultimately informed by what are equity futures doing. And so to some extent, I think it's fair to say that we have a put that is sitting below the market, given how much the president utilizes the market as a gauge of how the country is doing. And so given that, I think when you start to see the equity market respond in the way in which it has, I do think that through time, you will start to see the narrative shift from the president toward more pro-growth policies, toward policies he thinks will ultimately promote the long-term sustainability of the U.S. economy. But he balances those things, and he doesn't like to find himself, too far left or too far right, as it relates to that. And so I think we're going to continue to see a lot of noise, and I think that noise is going to create also, I mentioned a floor or maybe a put that exists, but I also think that probably creates a cap on where equity prices can move in the near term.
So do you think the first half of the year is going to be very different from the second half of the year because of everything that's coming out of Washington?
I think the first half of the year is going to be really bumpy. I think what the market is already telling us is we're tired. We're tired of executive action. We're tired of executive orders. We're tired of hearing about tariffs in all of these different countries. And I think with that, I think we're going to see a market where we're seeing more volatility. And then I think it's going to be, how does the economy ultimately expand? We have to balance some of the challenges of stagflation with some of the challenges of how do we continue to make sure that we're maintaining growth throughout the first half of the year. And so the market in the second half of the year is going to be highly, highly dependent on how well a job we do at balancing those two factors.
Hey, just a little bit of time left and wanted to touch on crypto. Speaking of volatility, how do you do crypto at the firm?
Sure. So we are in the digital currency space. We do trade crypto. We don't have a directional view on where crypto is going, but there are certain types of opportunities that have come about by the creation of new crypto products, whether that be some of the new ETFs, the ability to trade futures, the expanding ability to trade futures across a larger amount of digital currencies, all creates opportunities for us. And so we have started to deploy capital in some of the basis trades that I think have been written about a fair bit. We have worked closely and partnered with the banks as it relates to how we can deploy our balance sheet around some of those strategies. We are thinking through how we can expand our digital currency trading strategies more broadly. Today, it's still a relatively small percent of our risk capital, but it's something that if you ask me over the next 2 or 3 years, based off of a combination of what I think we'll see from a regulatory policy perspective with a combination of what I think we'll see from a market structure, market participant perspective, will likely become a greater percent of the risk in the portfolio than it is today. But it will still be one of many strategies we deploy at Schonfeld.